Okay, well, good morning, everybody, and welcome to Expiration and Jobs Friday. And that's not spelled Friday. It's spelled Fryday. But, anyways, listen, I want to start this out by saying one thing. You know, sometimes the old rules apply. And one of Mr. Topstep's rules that we made up from the trading floor many years ago, and I think Rich will agree with this, is that it takes days and weeks to knock the S&P down and only one to bring it back. What do you got to say about that, Rich?
It can work both ways sometimes too. So I mean, some of the down moves get pretty vicious, but yeah, I actually had said or way earlier in the year that in the S&P the low for the year is in. I'm still maintaining that is the case. It doesn't mean that we won't dip down and have negative months like last month, but I think the low for the year in the S&P is in. And listening to what you were just saying about not wanting the market to go down, whether we remember the old plunge protection team days. That was Clinton. So that was a long time ago. And to think that they may still be doing that kind of stuff, probably are.
Yeah, I think they are, especially in an election year.
Especially in an election year. And I have a study, and the election year statistics, I have to give credit to Yale Hirsch. I followed him way back in the 90s, and he was one of the first guys to look at those. And Jeff, has carried on that work, but I programmed it in to one of my algorithms too. And there's definitely during presidential election years, since 1970, there's only been two years that the market was down. And that was when Bush Jr. was elected and when Obama was elected. The only thing that happened in those election years when it was down, and it had nothing to do with either candidate, but what I found interesting is that Clinton, a Democrat, was in office and a Republican got elected in the down year. And during the financial crisis, a Republican was in the office and a Democrat got elected. So,
right.
And I think I was talking to somebody last night, about the current, apparent candidates for the election right now. I just feel uncomfortable that both of them are so old. I mean, yeah. I have a low opinion of politicians in general. So I'm not going to get into, which candidate is better or whatever.
Rich, I think everybody agrees out there that, and it would sound funny coming from us, we're older, but, there's no doubt that there has to be a change. There has to be younger people.
Absolutely.
Younger people brought into the government. But anyways, let's get back on track. I've seen a lot. I follow price action and patterns, but not like to the depth of you do. But over the years, I've always noticed that what happens is, when you're going into like a big Fed meeting or something, the markets get soft. They, whether it be earlier in the week or whatever, the day of, the markets sell off. But then the next day, or even that day, they start to rally. Why do you think that happens? I know that the markets were oversold, but we've had a big rally, Rich. How much have we gone up, and are we breaking out now? What's the story?
Well, it depends on when you're asking how much have we gone up. I mean, this is I keep a cash chart in the S&P, and I have all kinds of labels and text on things. This is looking back a couple of years. I mean, we just had this rally from the last week of October until March, where it rallied 28.29%. We only had two small pullbacks in there, 2.32 and 2.54. I mean, there was a couple of 1% down days. And then this current pullback from the high to the low was a little over, almost 6%. And then we've subsequently made a 50% retracement of that.
Yeah.
And if you look at some like this down move that was a 10% down move back in, what was that? That was back in 2023. But we had a 20% up move. And the thing I'm just going to point out in here is we had a lot more pullbacks in here. And then when it did pull back, even in this down move, they had some big, pullbacks up. This, I think, from October to now is one of the biggest rallies I think we've ever had with so few pullbacks up until now. I mean, that was like 6 months without a 5% pullback. And if you go back, and look way back, I mean, we've had a lot of pullbacks, and here's the old high when we made this old high. Ooh, way back here. I guess I got to scroll back to like 2020, whenever that high was. I mean, 10% pullbacks, 5-6% moving around. So it's kind of unusual, I think, this latest rally that we've had for 6 months, that it's been so void of any kind of pullbacks. And now we're having a little volatility, but we're at new all-time highs. But I don't look at these highs as being really all that high for a couple of reasons. First of all, inflation naturally makes prices higher, and it not only affects prices at the grocery store and the gas station, it affects prices in the stock market.
Right.
I mean, there's more money to go around, so it's put someplace, and we're really not kind of right where we were a couple of years ago when we made that other high. I don't remember what the exact number was, but I can look that up. So I think that as I say, based on what I'm looking at here, the low for the year was where was it here? Here it is. It's right down here at and we just came back 5%. And even though we were within a few percent of the 2023 close, the low is still a few more percent lower. And I don't think we're going to take that out this year. My studies indicate, based on the rally that we had and the fact that it's a presidential election cycle, this low is not coming out. As I say, but we're going to have some negative months. I think we're going to like just ping pong back and forth, through a couple of trading ranges and make some new highs. And we're going to be higher by the end of the year. And let
me ask you, how high do you think we can go before the end of the year?
Well, my real number, you really want me to spring that one on you?
Yeah.
I think they could be up 19% by the end of the year.
And where would that put the S&P?
5,700.
Yeah, that's what I thought you were going to say.
Yeah.
But Rich, you actually said that. You actually said that.
I said that in January with my model.
Yeah, right.
I'm sticking to the model. Granted, when we came down here like last month, I was a little nervous and about what I was saying. Now I'm like calming down. I hate to go back to it, but I really think if we had a couple of younger candidates not caring about the party, I think a lot of people would feel more confident about the future. I mean, these guys are 80 something years old and you're talking about 4 years of the hardest job in the world. I mean, it ages people like, unbelievable. And I just I think that I just wish it was a different case. for a lot of reasons.
Well, the one way or the other, that's going to have to change. But look, I've said that I don't think that the government really wants the markets down, and I think just the way this coincided with the markets being weak going into the Fed meeting on Wednesday, that somehow or another this isn't just a coincidence. It's like, could it have been mapped out? I mean, if it was, they did it perfectly.
I actually have, forgetting about that. I did a study on. I do all these event studies. I do studies on PPI, CPI, FOMC, and what I take the dates that those events took place on and see whether the market was up or down for that day. And my study for this unemployment day said that this would be an up day,
Yeah.
and it has been, and I think that it's going to be. And I'm really looking for this. I think we could go. Looking right here, we just touched the 2 standard deviation level, and we pulled back one standard deviation, which we're finding in my room that's the case, that the market does that quite often when it has a pullback, or even when it goes down, it comes back up a standard deviation. When it goes tops out, it'll pull back 1 standard deviation, and this was almost a perfect 1 standard deviation move back down. But I'm looking at things like right now. I think we could be, I think we could go up to, a lot higher today, maybe up to this 3 standard deviation level.
Well, I pay very close attention to the gaps, right? I love trading the gaps, and I find it funny that today, out of all the major gaps that you've pointed out and seen them reverse and go your way, that today you came in and you were no selling the gap.
It was way too big. I mean, first of all, the size of the gap matters, and I still have my gap stats up here, so we can look at them.
Well, let me ask you: is there like a percentage point up or down that you look at?
No, that's all factored into my gap studies, but these gap studies look at the day of the week, the month of the year, the size of the gap, what happened in the prior day, and several other factors. So it's not only the size of the gap. I mean, it looks at a lot of factors. I think I said I have like 140 different factors that this looks at, that I can modify what these probabilities will be. And this morning, because we had such a huge opening, I mean, the S&P was opening when I ran this over a 1.1% higher. That's really high, and this time of the year, that's an unusual size gap. Then the NASDAQ was even a larger gap. We were like 1.62% up. That's like way up in the very few gaps get to be that size.
Yeah.
And when they're that big, and the type, I differentiate gaps. I have about 10 different types of gaps that I actually look at, and I differentiate them based on a lot of factors. This kind of gap with this size rarely, it like basically never fills. It's just too big, and there's not been that many that big. I have all the stats on that, and I actually the people that subscribe, I have a gap course that those statistics are all available for people to download and take a look at. And I'm always updating and adding things, and I actually just this past week figured out one other kind of matrix that I wanted to look at with gaps, and I always write down what I want to add, and I think it's going to be a pretty significant contribution to my outlook on gaps. And so I'll program it in. It'll take me a little bit, but and then I'll see if it's something significant.
Yeah. Well, I want to ask you something, and I really, really believe this. When you were on the floor, you did out trades.
I did out trades.
Hold on one second.
Yeah, out trades. Here we go. Oh, let's take a look at this real quick.
Come over here. That'd be great. When you were on the floor, you did out trades, and those out trades, a lot of times, if there was a problem with a customer or a problem with a local with too big of positions, you worked directly with the compliance department. I mean, not the compliance, the margin department, the risk department, right?
Well, here's what you did with out trades. First of all, every trade had to be settled prior to the opening of the market. You had to settle responsibilities of who was going to be responsible if there was an error. And there were price outs. Like somebody said, I sold them to you at a half. The other guy said I bought them at a quarter. Not a problem. It's just a little bit of money. You're only talking about price. So and there were all kinds of rules and that were about settling those prices, but we absolutely had to have responsibility fixed for price and the quantity
right
by the time the market opened. So somebody had to accept responsibility, and that was what we did. We got together the parties and made sure. And a lot of times, as the clerks, I mean, we represented our firm, so we could do what we had to do to get it done. And we represented. What
you had to do is you had to make sure all the prices and quantities and firms were correct.
Exactly. And some of those outrates.
I guess maybe I said this wrong. Maybe because we at our desk, when like say Marty was trading big and he had 10, 20, 30,000 options on, we had to work very, very closely with the margin department. Sometimes on and for whatever reason, you would not think this would be the case, but if he had Friday expiring options on, and the position was perfect going into the end of the week, he would always get a margin call, even though the positions were expiring the next day, and they would require him to put up a lot more money, and he would have to adjust, come up with a $10-20 million margin call on short options that are worth nothing, But anyways, to kind of further this, I think what happens is once the market starts going bid, everybody sees it go offered for a week, 2 weeks, 3 weeks, every rally, every dead cat bounce or selling and down to new lows, right? And we make that new low this week or yesterday, and we bounce and we don't stop bouncing. No, what happens in my world is once the market starts keeping going up and goes above these collars and above the big figures and starts squeezing, the margin calls start putting out margin. They start putting out margin calls, and those margin calls, the guy's got a couple things he can do, right? He can put up more money, right? He can roll his position, or he can liquidate. And the fact that options now take up so much space in the trading world that, I guess futures, they can say, well, the futures are oversold. Well, I don't know. That could be, right? But in the real world, you know what your future is going to cost when it's up 1%, 2%, 3%. But you're not going to know what, if you bought puts and sold calls, what those calls or puts are going to be worth when you're up 2, 3, 4%, because everything gets so skewed. my own opinion is yesterday when we started moving up, these margin calls started coming out. And, you rally 80, 90 points in a day, that changes everything very quickly. And then to this morning. So I think, my own opinion is I agree with you.
Well, I actually have another kind of a viewpoint on that. And the 0 date options, the options on the given day, if you trade options that are 3 weeks out or 3 months out or 2 months out, you can hedge those. You can hedge those options, whether it's with futures or the underlying stock. If they're stock options, you can hedge them. There's not gamma risk. These 0 date options, at the end of the day, they've either got a delta of 1 or 0, and the gamma is so large that when the market starts moving, it kind of feeds on itself, and you can't hedge an option that
is expiring in 2 hours.
that has a delta of 0.5 that's expiring in 2 hours, and if you move 10 points, it goes to a delta of 1,
right?
Or it has a delta of 0.2 and it goes to 1 in the last hour. You can't. The only way you can hedge those options is to buy them back, and
right.
So that's why I think we get some of the moves we do, especially late in the day and during the day, because my term, I call them gamma monsters, because they start out and
small and they blow up.
You buy these 25 or 50 cent or dollar options, and you get a big move, and all of a sudden they're worth 10 or 20 bucks, and you paid $1 for them. Well, the people that sold them, when the market starts moving that way, have to buy something. If they sold calls for $1 and now they're trading $5, they got to buy something back, and then all of a sudden they're trading $10, they got to buy more, and it just
feeds on itself.
It feeds on itself, just what you were talking about. So that's what I perceive taking place these days, and consequently we do get some wild moves, and we get a lot of 1 standard deviation moves, and I have a couple theories about why some of these moves happen to be 1 standard deviation, but I think these zero date options are, and I love to trade them. I mean, it's a great thing to trade. I think as long as you're long those options or you trade spreads, you can't be naked short any of those, because if you can make a lot of money. There's a lot of theta and they move, but you could make money for a year every day, millions of dollars, and then in one day be wiped out if it moves wrong.
Well, I understand the thing. You got an option position on, it's going against you. You don't want to get out. Go buy some futures. I'll tell you what, Pitbull never did that. I mean, very seldom would he, have 20, 30, 40 big options on and then say, oh, I got to go buy 400, 500 futures. If something was blowing up, I mean, like to the worst, he may do that, but very seldom. But what I was trying to point out is that I just think that, we would see all this in our desk. Here, I want to back up and I want to tell a quick story. When Pitbull decided that trading the S&P had become too hard many years ago, he called my desk and he said, "What am I going to do? This is too hard now." And he's still trying to do it, and it's just difficult if that's all you're doing, right? And he does a lot of other stuff. But the thing is that I remember when he came to our desk after being a give up customer, and he opened up a large account, and he had $35 million in the account, and he took that account, being a premium seller, and adding as he made more money. He took that up to over $100,000.
100 million, you mean?
Yeah.
100 million.
Yep. And what did he tell you? Did he tell you? Did he ever tell you that I gave him the best advice anybody had ever given him? And
No, I haven't. I haven't
oh,
heard
I
that.
thought he told you that. Well, anyways, when he got up 100, when he got it up, it was a little bit over 100. He called up the desk one day, and he said, and I knew about what these short premium sellers, they, Niederhofer, all these, everybody blows up eventually, right? And he said, what am I going to do? Blah, blah, blah. And I said, Marty, I'll tell you what I would do. And he had thousands of options on. I said, I'd tell you what I'd do, Marty. I said, you put 35 million in, you got it up over 100. I'd take 50 million out and put it back in the bank. And if you blow the other money, you're still going to be up 15 million. That week came into a China PMI. I can't remember. It was in August of something, and 2015, I think. And all week long, he fought with that position, and getting margin calls in the desk and rolling and buying and selling and just it wasn't good, and I knew it wasn't good. But anyways, finally on Thursday, he called the desk. He said, I don't know what's going on, And I said, I told you, the China PMI, everybody's banking on this thing, and the futures were going down and the puts were going up. And I said, I told you, I thought you should get, you should get out. He's like, I can't get out. It's going to cost me $13 million to get out. And I thought to myself, how stupid. You took 35 million up to 100 million, and you're not getting out. So anyways, he ends up getting out, right? And he called, and it blew the desk up. He got out of 35 to 40,000 big options in the pit. And then the China PMI number came in on the open on that Friday. And I know you remember this. The futures, the Dow dropped 1,000 points, and the S&P were down. I think, I can't remember, 100, 200 points. I can't remember exactly. And what happened was the VIX on the SIBO locked up, and he got out of everything, and he lost like $40 million on that trade, and maybe even more. And I thought that he was flat because he told me he got out. But what he did is he managed his money for his kids, and he got the kids out and rolled his position down instead of liquidating. And and then he took another hit and basically went from up 100 to 105 million back to the original 35 million. And he always said to me that advice was the best advice that he had ever gotten from anybody in his whole trading career. But I mean, we know how this short option stuff ends up.
I was actually trading in the S&P options and the NASDAQ options when Niederhofer blew up.
Yeah.
And he used to just come in and sell thousands of those teeny puts.
Oh yeah.
And
they're a dime bid, and they're selling gazillions.
They're selling 10,000. and I mean, in the NASDAQ, I remember in the NASDAQ, they would be like $200 or $300 out of the money. And that's when the NASDAQ was trading at like 1,500.
Yeah.
And so he'd go in like the 1,000 or 1,200s that were trading for a dime. He'd, sell 10,000 of them. And he kept doing it. And,
yeah. Well,
and
then it works until it doesn't, and then it's kapow.
All
right, so let's do this. I don't think we need to take a lot of time today. I want to let everybody know that, Rich is continuing his work. It's getting better and better and better. Let's close it out like this. If you could pull up a chart or something, and where do you think we go out today?
Well, apparently, I mean, right now we're sitting above the one standard deviation level in the S&P at 5126.77. And we just closed in here. I think if the I actually think we're going to go out higher than we are right now. I think if we can rally back up to the looking at this, if we rally back up to the 44, 45 area, if they hold this, I mean, if they don't hold it, hold these lows that they've just made here at the 1SD level, if they dip down here, they could go back down here to the 107, which is 20 points lower from what this low was here approximately. But if they hold here and get back above 45, I think we have a shot at maybe making some new highs.
All right, let's do this. I'm gonna make a guess. I say that we do rally today, and that there's a possibility that if we can get back above the highs and hold above 5150, that we can say 5180 today. 5175, 5180 is my call.
Well, I think if we get back above the 2 standard deviation level, I think my next target up is 5173.40, and above that is 5196.81. And I said yesterday with this rally, with what I was looking at, my target, basically I thought we were going to go back up to 5200 area.
Yeah.
So, as long as we hold this today, even if we close above this 51 quarter area, right, that we're trading above right now, next week we're going to hit 5200.
Yeah, I agree.
And the NASDAQ, I think I have, above 18.2, it goes to 18,000. It should go to a little over 18.1 something. I don't even know what the high was in there. They didn't. The high was around 18,050 or so, and I'm looking for that to go to like 18,200 sometime next week. And as I say, I think we're gonna. I really think that the next few months are going to be really good trading months, because I think we're going to have a lot of these moves where it goes one direction, 100 points, and then it turns around and goes back the other direction, 100 points. And you definitely don't want to fight the moves, because I think that if you can get in right, you gotta ride with them whether they're up or down. Because I think not that volatility is going to be that high. I just think that the market's kind of directionless, and at these levels, there's no reason why we shouldn't have 50 or 100 point moves in opposing directions on a regular basis. So
the other thing, I don't think you go down for 2 or 3 or 4 weeks and you knock out all the shorts in one day. That ain't happening. That's not happening.
Well, I was really, really bullish until about the first week and a half or second week of April, and it was the first time that I said, I said, that you could start selling them. Before that, I think everybody knows that the trend was so strong, they never dipped, as illustrated by that cash chart that I had, where the biggest dip until the end of March had been 2.5% in like 6 months,
right?
5 months. Now we're in kind of a different era here, and as I say, I think we'll be rolling, bouncing around in this range, 1 or 2% moves, weekly, up and down, just back and forth. And depending upon what the sentiment is on any given day, we'll just be moving around, bouncing around in there. And that's one of the things that I do put out are my weekly standard deviation levels. I put those out at the beginning of every week, and I put them out in on the sheets on my website for the subscribers, and then I also put out a chart that I dump in with the Sunday night stuff. So people have these weekly standard deviation levels, and you have an opportunity to kind of have an idea about where the market is. And I did a study going back 2 years on my weekly standard deviation levels, and they fit the empirical model. So although they have fat tails, and fat tails means that you have more events that happen, outside of 2 standard deviations than you would anticipate. I have a theory for why the market behaves like that and why we have fat tails in trading. But I think we're going to do a lot of this bouncing, 1-2 standard deviations on weekly levels, just back and forth for the rest of the summer.
Yep. All right. Well, listen. Let's call it a day. I want to thank. Hey, Rich, thanks for coming in again as always.
Always enjoyable, Danny.
Everybody out there in TV land, let's be safe and have a good weekend.
Thanks, Danny.
You got it.